So what we're gonna do today and this week. So we have three classes this week. Monday, we're gonna do Wednesday, and we're gonna do Sunday. So what we're gonna be doing is really going over the basics, right? So everything I do is the basics. Nothing I do is advanced at all. The biggest thing I do is use the basics together to get the probability of the stock doing one thing more than the other. That's literally all I do. I have certain principles that I really focus on that I put together to find plays, to trade, entries, exits, all that kind of stuff. I'm gonna go over all that with y'all. It's not gonna be like super duper long classes, but I am gonna give you everything you need to at least put you on a path to where you're gonna know what to study. Or when I call things, you're gonna know why I'm looking at it. Because sometimes I don't have time to signal a day trade. Especially we trade like weeklies because sometimes I can get in something. Let's say I get a contract at 2.32, right? And 2, 3 minutes go by, it could be at 2.5, 2.6, and that's just you just way too far. So I want everyone to be able to know the strategy. That way you can really see it on your own. That way when I send a watch list, you already know exactly what to look for. So we're gonna do that. Like I said, the microphone goes out. I'm gonna turn my ringer on so one of y'all can just text me. Like I said, most of y'all have my number anyway. So I'm about to turn the camera on. We're gonna be on the whiteboard today. So we're gonna really get to it. Let me see here. All right, about to change the audio. So y'all let me know if it's working or not in just a second. All right. How does it sound? Is it a little bit clear? I don't know if it's changed over yet. No, I don't think so. All right. Now it should have changed over. How does it sound? Is it clear? Muffled? What's going on? Yeah. All right, cool. I'll go ahead and get started. We're on a whiteboard, man. Hopefully y'all can see that pretty good. It does look a little bit blurry, which I don't like, but you can see it for the most part. And of course, it's recorded, and I'll be talking. And this is pretty much a lot of the same stuff that is on the videos that I have 4 parts to. So, if you kind of can't see something, if you miss a little something, then you can watch the video. Let's see. Try to make the try to make the screen right here like the main screen. I know if you kind of have it at the top, it'll be hard to see, but if you make it the main screen, you'll be able to see it pretty good, especially if you're on a laptop. I'll move this out of the way though. All right. Let's see. All right, today we're gonna be talking about the pillars of options trading. Like I said, at any point, if it starts to mess up, somebody call me, shoot me a message or something. All right. So RJ's pillars of options trading. All right. So I trade using certain pillars or concepts that I call them, right? And these things are important because you have to know the basics no matter what strategy that you decide to trade, right? So I have 6 to 7 things that you really need to understand. No matter if you're going to trade my strategy, if you're going to trade someone else's strategy, it doesn't matter. You're going to have to use these at a certain point. All right. So we're going to go ahead and kick it off with the first one. And we're going to talk about contract basics very briefly. Okay. So, number one, we're going to talk about contracts. So, the basics of options contracts. All right. So, options and trading stocks are two totally different things. All right. So, to give you a synopsis of it, if you say, let's say a stock costs $100, it costs $100 for you to get one share of that stock. Okay. An option will give you the obligation, it will give you the right, but not the obligation to get 100 shares of that stock at a given price. All right. So if the stock goes up $1 and you have one share, you will make $1. If the stock goes down $1, you have one share, you'll lose $1. And you have to multiply that by how many shares you have. Options is a whole different ball game. All right. So with these options, you are paying less to have access to more in a sense. All right. And we're not trying to exercise the options. We're trying to flip the money on the options. We're trying to buy an option for 120 and sell it for 150. We're trying to buy it for 600 and sell it for 1,000. Right. We're trying to do things like that. Okay. So to give you a little visual, if a stock costs $100, okay, and we're going to do S for stocks, O for options. All right. And we're going to use $500. So we got 500 here, 500 here. Okay. So with $500, you can have 5 shares. All right. So this stock goes up $1, you've made $5. This stock goes down $1, you've lost $5. Options going to be a bit different. Let's say you have option contracts that cost $100, right? So the option contract and the stock costs $100, right? Let's say that option has a what we call a delta, which we're going to get into, of 30. Okay. So with this $500, you can get 5 option contracts with a 30 delta. This means for every dollar that this stock gains or loses, depending on which way you bet, because we have calls and puts. Calls means you think it's going to go up. Puts mean you think it's going to go down. If the stock goes up and you're betting on it to go up, you're going to make or lose $150 for every dollar that it goes up or down, depending on which way you bet. All right. So you have the same amount of money that you're allocating towards this stock, just in a different way. All right. So you see, you have leverage here to a whole lot more money to make or lose than you do from buying a stock. That is why options trading has become so popular and so powerful, because people are trying to turn a little bit into a lot, and that's not always a good thing. All right. So that's the difference between stocks and options. Now I'm going to quickly talk about 2 contract Greeks that you need to know. And there are a little bit more, but these are the 2 main ones that you need to understand. All right. So of course, when you did your homework, is going to be to look up strike price, premium, bid and ask. Look up things like that. You need to know those. But just for the sake of time, we're going to talk about 2 of the Greeks that you need to know. The Greeks are important because they give you information about the contract and how much you're going to make or lose, things of that nature. The Greeks there are 2 that you need to understand. All right. So number 1 is the delta. Number 2 is theta. Okay. So what is the delta? The delta is how much you're going to make or lose per dollar that the stock goes up or down, depending on which way you bet. Remember, calls, you're betting on it to go up. Puts, you're betting on it to go down. Okay. So whichever way you bet, you're going to make or lose that amount of money. And these options are priced, you have to multiply it by 100. So you may see a delta that says 0.32. This actually means 32. Okay. So you're going to make or lose $32 per contract. How many contracts you have, multiply it. All right. Super important. That's delta. Theta is the tax that you're going to be paying every day on your option, regardless of anything. All right. And you also multiply that by 100. Typically, you want to have a higher delta than theta, especially when you're swing trading. It doesn't matter as much if you're scalping or looking to be in a trade for a very short amount of time, but especially with swing trading, you definitely want the delta to be higher than a theta, because if not, if the stock goes sideways, you're going to be losing money faster than you're going to be gaining it. All right. So that is a quick synopsis of contracts. Number one, you have to understand contracts. All right. Number two, we're getting into the technical analysis. All right. So this is the part that people kind of like, but we got to go baby steps. Everything that we're going to talk about is in an order for a certain reason. Getting into the technicals. Everything that I like to do is from the charts. I do fundamentals just a little bit, but you need to understand these charts when you trade it with me. Understand the charts. First thing that you need to understand is the time frame. Time frame. Why are time frames important? Time frames are important because the best way to trade that I've found is to do what we call top-down analysis. You guys may see me say from the mountain to the field. What that basically means is we want to see what's going on in a larger time frame and then bring it down to a smaller one, because the larger time frames take precedent over the smaller ones. So I love to start with a daily or 4-hour chart and make my way down. If you can find a trend on a larger time frame, you can easily trade it on a smaller one. Okay. So that is time frames. And you have things such as you got a daily chart, you have a weekly chart, you got a monthly chart, right? You got a 5-minute, you have a 1-minute. All right. Now, let me show you why time frames are important. Let me give you two scenarios. Let's say you don't know what you're doing, right? Let's say you don't know what you're doing and you see a chart and you see the stock is coming down, right? You see the stock is constantly falling down, all right? But a person tells you that it's falling down, and that's a 1-minute chart, all right? Let's say we're looking at SPY, something that we know what it looks like. Let's say we're looking at SPY. On a 1-minute chart, SPY has been coming down. Let's say it looks like it has recently. But what this person doesn't know, because they don't understand time frames, is if they look at SPY from a larger time frame, on the daily chart, SPY looks something like that. Okay. So they're going to end up losing money eventually because they don't understand what's going on in the larger view. It's much easier to trade the larger time frame trend than it is to try to catch the opposite of it. Okay. So time frames are super, super, super important. And once again, all of this is gone over in depth in the options videos, the beginner options videos that I have. Okay. Number two, time frames. Number three, and arguably maybe the most important part of technical analysis, is understanding candlesticks. This is super, super important. If you don't understand candlesticks, you will not be able to trade the way that I trade at all. All right. And candlesticks have many different names. I would be lying to you if I told you that I knew all the names of the candlesticks. I don't. Okay. Let me tell you what's important. And my last mentorship group came up with this that is super, super cool. There are three things that is important about candlesticks. You need to know O, C, W. All right. And I'm going to constantly check my phone here just in case y'all are sending something. OCW. This is the only thing you need to understand about the candlesticks. OCW. What does this mean? Where does it open? Where does it close? And where are the wicks? The only three things you need to worry about. Where does it open? Where does it close? Where are the wicks? Okay. The color sometimes is really irrelevant. All right. Why do I say that? You need to know where a stock opens. So let's say this is a basic candle, right? Let's say the stock opens here and it closes here. All right. So this is the open. This is the close. If the stock closes lower than it opens, it's going to be a red candle. Simple. Let's flip it. If the stock opens, if it closes higher than it opens, it's going to be a green candle. Simple as that. All right. If it closes higher than it opens, it's going to be a green candle. That means buyers are trying to step in. If it closes lower than it opens, it's going to be red candles, means sellers have stepped in. Now, think about this. How can you implement the candlesticks with the time frames? This is what you're going to start seeing as we go along. You have to understand that these candlesticks are relative to the time frame. The daily chart has the time frames. The daily chart time frame has candlesticks that means that each day this is the candle that happened in that certain day. Like 1 minute, this is what happened within that 1 minute time frame. It's relative to the time frame. Okay. So always understand that this stuff is going to be running together like this. So please understand this. Okay. So open, close, wick. All right. Let's talk about wicks. Why are wicks important and what do they mean? Wicks are important because they tell you about the buyers and the sellers. It doesn't matter the color. OCW. If you have a candle, you got a long bottom wick like that. This wick tells you, a long bottom wick tells you that buyers were able to push out the sellers in this given time frame. If we are on a 1 minute chart, this means within 1 minute of this stock's movement, the sellers were able to push the stock down, but the buyers were able to push it up before the candle closed. Long bottom wick, bullish. Buyers are trying to take over. Let's talk about opposite. All right. Notice I haven't mentioned the name yet. Long top wick. Typically a bearish candle. And this means that at some point in time during this time frame with this candlestick, the buyers were in full control, but the sellers were able to push the stock down within this time frame. Okay, within this one candlestick, within this time frame. All right. So OCW. All right. Long top wick. The stock at this given candlestick is a bearish candlestick. Long bottom wick. This given candlestick is more than likely a bullish candlestick. And it also depends on where you see it. All right. So once again, more in-depth breakdowns on the YouTube videos. Please watch them. Please watch. Let me see if I can adjust it a little bit. Say it's a little bit blurry. I don't know how to fix it, but all right, what we on? Number four. Number four. Number four. Number four is levels. All right, levels, the same thing as support and resistance. I like to call them levels because a stock can be a support in one place and then that same place can be a resistance later. Okay, so what is support and resistance? Support is a place that the stock has trouble going below. Okay, think of it as sort of a floor. All right, a support is like a floor. Stock can't go below the floor. A resistance is a place that the stock has had trouble going above. Okay, so the resistance is kind of like the ceiling. You can't go higher than the ceiling. You can't go lower than the floor. All right, and remember, I call it levels because it can act as a support in one place and a resistance in another. Now, stay with me right here. A stock can be a resistance, can break the resistance, come back down, and start holding it, and now be a support. The same exact line, same exact area can be a support and a resistance. Now, when you are plotting this, you typically want your support or resistance to be touching at least 3 times. Okay. And you're going to ask, does it need to go through the candle body or the wicks? I love to do it by the wicks. And if it doesn't have a wick, it needs to go by the end of the candle body. Okay. So that is a part of levels. Now, let's also talk about how do we incorporate this with things that we've already learned. All right. So levels and time frames, how does that correlate to each other? The larger the time frame, the stronger the level. Okay. So if we're on a daily chart, we know each candle represents a day. All right. Let's say that this is March. This is March and this is October. All right. So on this chart, you got a stock that has not been able to break this one resistance for months, okay, is a very strong resistance. All right, so you got 1, 2, 3, 4, 5 touches over this span on the daily chart. That means it's very strong. So what this tells you is it's likely to reject, but if it does not reject and it breaks, it is going to give you a good move. Okay. Now, let's talk about a smaller time frame. Why do we look at the larger ones? Because you can also find a support or resistance on a 1 minute time frame. Let's say 9:30 and this is 10:30. Let's say this stock has had trouble here. All right. This stock is more than likely to break because this is not a large time frame level. Now, when you are plotting your levels, make sure that you label them because you don't want to be day trading or trading at all and you don't know what a level is. Because let's say that you are trading and you get into a stock at 950, but you don't know that this level that is by is a daily level. You're going to be sad when that thing gets rejected. Okay. You're going to be looking very crazy when it gets rejected. So always, always, always label your levels and understand what they are. Let me fix the whiteboard real quick. Hopefully I didn't mess it up some more. Yeah, I know some of y'all said it was kind of blurry. Hopefully I didn't mess it up some more, but we'll be all right. We'll be cool. All right. So that is levels. All right. And let's talk about how we incorporate levels also with candlesticks. All right. So like I said, right before we stop talking about candlesticks, not only is the candlestick is important, it's important where you see it. Let's say you have a level. All right. So this is where you have to really start understanding, pay attention. Let's say you have a support right here. What type of candle do you want to see at a support that tells you that buyers are stepping in? All right. Let's say that this support has been holding for 3 years. The stock has not been able to get hit for 3 years, but the stock has been coming down, but it really hasn't been doing anything. You just been getting regular candles, but one day you get a candle like this at the support. The candle looks like this. Long wick at the bottom at support tells you that buyers are stepping in and your probability of this stock being about to make a up move is a lot higher. Okay. You might not even realize it, but we just use all 3 of these technical pillars to make that inference. We just use the time frames. We said it's a daily chart. We just use the levels, got support, and we just use the candlesticks to tell us that this is more than likely to push up than to push down. Okay? All right. Don't let it lose you. Don't let this lose you. Okay. So after levels, you have trends and trend lines to make sure my mic is still going. Yeah. What number we on now? I forgot. Let's say 5. I don't know. We got trends and trend lines. Okay. So what is a trend? A stock moves in 3 ways. It is moving in a higher high, higher low, lower high, lower low, or it's going sideways. All right. So when the stock is moving in higher highs, higher lows, it typically looks something like that. All right. Higher high, higher high, higher high. Get the gist? It's a higher low, higher low, higher low, higher low. Okay. A stock looks like that, it is bullish. All right. Now, the other way is when a stock looks bearish, it looks like this. Lower high, lower high, lower high, lower high, lower low, lower low, lower low, lower low, lower low. Now, why is understanding the trend important? Understanding a trend is important because, stay with me right here, it's super important. This is going to help you stay in a trade longer. This is going to single-handedly help you stay in a trade longer. If you can understand that when a stock is moving, it's not going to go straight up and straight down, then you can be able to stay in this trade longer. Let's say if you get puts, right? Because making lower highs, lower lows, and let's say that you have other pillars that are telling you that it's also bearish. Truthfully, if it's not making, if it never breaks that previous lower high, you technically shouldn't be out of the trade. Technically, okay? Because the structure of this is still going lower, lower, lower. All right. If you start implementing this, especially in your day trade, try to implement this. I promise you, you're going to be able to hold trades longer. If you understand higher highs, higher lows, and you understand that stock doesn't go straight up, it doesn't go straight down. Now, there are a difference between higher highs, higher lows, and pullbacks and sell-offs. Those are different. And sometimes it's a little harder to see. But a lot of times when things are going to sell off instead of pull back, you'll notice that the volume gets higher. All right. And we'll talk about indicators in a minute. All right. Now, trend lines. Trend lines are pretty simple. Trend lines can act as a support or resistance. Okay. So let's say you have a stock that is trending up, making higher highs, higher lows. Trend line might look something like that, right? And this is acting as a support. Okay. And it really moves the exact same way when it's going to the downside. All right. So when it breaks the support, let's say if the stock was to break down, then you could possibly look for the trend to change. All right. So a trend line acts as a support or a resistance. Okay. Now, there is a strategy that I'll tell you right here because it's very simple using trend lines, and that's called the three-touch rule. Okay. So the three-touch rule means usually when a stock visits the trend line for the third time, which I didn't line it up all the way, but get the gist. Get the gist here. When a stock touches for the third time on the trend line, usually it's going to continue in that direction. And the most recent example we have of this, if you look back into the Discord or even on the Instagram page, you will see what we're talking about DIA, right? So the Dow, it had a third touch rule and it had a lot of other basic principles that we was just talking about. All right. And those contracts went from about $300 to, I think now it's like over 1,000. It might have came down a little bit, but at one point it was at $1,500 per contract just from seeing this three touch rule. All right. Once again, all of this goes over in depth on the YouTube videos. All right. So really the last one here, we got two more, but this is really the last one. And this is one that y'all like the most, chart patterns. So y'all might say, well, RJ, I know you love chart patterns. Why are you talking about this one last? This should have been first. You can't understand a chart pattern if you don't understand candlesticks and time frames and levels. You don't understand those things, you will never understand the chart patterns because a chart pattern is made from a combination of the candlesticks and the trend lines, or the candlesticks, trend lines, and levels. All right. So I'm gonna teach you, I'm gonna give you two of my favorite patterns here. All right. And I'll let you dig for some more. I'll let y'all, that'll be your homework to kind of dig for some more patterns. My two favorite patterns are the flag and the pennant. All right. And those of you that trade with me a lot, you guys already know about it, but the flag and the pennant. So the flag pattern, number one, is a continuation pattern. When you see this, you want to trade it in the same direction from which it came. Okay. So if you see a flag pattern, what you expect to see, all right. And what's good to know here is that you have a bull flag and a bear flag. A stock is bullish, you expect it to go up. If it's bearish, you expect it to go down. With a bull flag, you're looking to trade it only to the upside. That's shown from when a stock has a significant run up and then it has a pullback, and then it will typically break out. So it will look a little something like this. And I wish I had a different color marker, but it will look a little something like that. You have a run up, you have a pullback, and you have a breakout. Okay. So you got the candlesticks, you're using these trend lines as a support and resistance for the stop, and then you have the breakout. Now, we're going to incorporate something else. Let's say you have a flag pattern, right? You got a bull flag on the 1 minute and then the 1 day. Telling you, this stuff keeps coming back now. The bull flag on the 1 minute chart can break out the same as a bull flag on a daily chart. The difference is going to be the candlesticks on the daily. Think about that. If a bull flag breaks out for 4 candles, right, on a 1 minute chart, let's say it goes up $1. All right, cool, with 4 candles on the minute chart. If those same 4 candles break out on a daily chart, that stock might be up $4, $5. So it just depends. So, like we said, larger time frame, larger move. This is why every day that y'all see me talk about my watch list or things I'm watching, it's from a daily chart or a 4-hour chart, right? Even with the day trades, because those large moves intraday. So something like Nvidia from today, y'all was able to catch that. Nvidia's move like that has only come from a larger time frame move. Okay, things don't just shoot up in the middle of the day for no reason unless there's news. Okay, so when stuff like that happens, it's something bigger that's going on that you have to zoom out and see. All right, so larger time frame, larger move. That's the bull flag. Let's talk about the bear flag. Bear flag is the exact opposite. All right, bear flag means the stock has had a significant move down, and then the stock has consolidated and you're looking for it to break out to the downside. Okay. And once again, the trend lines as a support and resistance. So you're looking for it to break the support. All right. You only want to trade it to the downside. And this is the secret. I will hold it. I'll hold it. We'll hold that. That's the flags. Let's talk about the pennants real quick before I say that. Talk about the pennants real quick. Pennants. So flags were continuation patterns. Pennants are neutral patterns. All right. So a pennant is going to look a little something like this. And I'm terrible at drawing the pennants. But it kind of looks like a triangle. I can never draw them right. But basically, the bottom trend line acts as the support, the top acts as the resistance. And it is a consolidation or a neutral pattern because think about what this means. These two trend lines are converging. This from the top is making lower highs, lower lows. From the bottom is making higher lows from the bottom. All right. So it's making lower highs from the top, higher lows from the bottom. Doesn't make sense. Of course it doesn't. It's a neutral pattern. So you don't know which way it's going to go. But rule of thumb, you still project it to go the way that from which it came. All right. So since it's a bullish pennant, you still expect it to go up, but you understand what the pattern means. It can go either way. Bearish pennant looks the exact same, right? So once again, I'm terrible at drawing the pennants. That was actually a little bit better. But you kind of expect it to go either way. There are bear pennants that break out to the upside. It's bull pennants that break out to the downside. Okay. So those two patterns are super important because they show up every single day. I guarantee you, if you look hard enough, you'll find a pattern like that every day on the market. All right. So let me say this about chart patterns. They are most powerful when the overall market is going that same direction as the pattern. What does that mean? A bull flag means that the stock is likely to continue upward. All right. So if you use your previous principles that we talked about and use that on SPY and QQQ, because you know SPY and QQQ usually is like the gauge for the market. So SPY and QQQ are bullish. You want to be looking for bullish chart patterns. Don't look for bearish chart patterns when SPY and QQQ are bullish. Play the same way that QQQ and SPY are going. If you're in something like you're in now, where SPY and QQQ is Ranging is going to be a lot harder to trade. It's going to be a lot more false breakouts because you don't have that overall direction from the market. But when that market gives you that overall direction, you have to take advantage of it. When SPY is bullish, QQQ is bullish, look for those bullish patterns. Don't even look for a bearish pattern. You see a bearish pattern, don't take it. All right. When they're bearish, look for the bearish pattern. You see a bullish pattern, don't take it. Be on the side of probability. All right. Probability is our best friend. Okay. Now, the last one, I don't know if this is number 6 or 7. I think I stopped counting right. But the very last one is the one that when you start out, you like it the most. And as you kind of mature, you realize that you don't need it. Indicators. All right. So you have all kind of indicators, right? You got the MACD, you got stochastic slow, you got the RSI, you got volume, you got the Bollinger Bands, you got Fibonacci. All those are types of indicators, right? But the thing is, indicators don't work unless the candlesticks are working. All right. So a lot of indicators are lagging, which means that they are lagging behind what the candles are doing. So if you understand the candles, you don't need the indicator because the indicator is only going to move by how the candle moves. All right. So you understand your candlesticks, you really won't need a bunch of indicators. I use 2. All right. So the 2 that I use is volume. You'll see me use that. And you'll always see me use RSI. And I use it for a specific reason. So let's talk about volume. Volume is important because a lot of times I like to trade breakouts, right? I like to trade breakouts and break and retests. All right. So typically when I get into a trade, it's for momentum. So if I want to see momentum, I want to see volume because that's telling me that people are trading the stock. There are buyers stepping in, there are sellers stepping in, whatever. All right. When you don't have the momentum, it's a lot more likely to be a fake out. Okay. RSI. Now, RSI, I love to use RSI because of a couple reasons. Number one, RSI, you have 2 levels that really matter, 30 and 70. So I got OS and OB. So when the RSI is below 30, it's considered oversold. You usually expect a bounce. All right. Now, when it's above 70, it means overbought, and you typically expect it to sell off. Now, the reason that you can't hold true to that is because this doesn't always work, right? Just because stock hits 70 on the RSI doesn't mean it's going to sell out. And if you don't believe me, go look at SMCI from last year, all right? Or go look at Tesla from 2019 to 2021, 2022, and tell me if it sold off, all right? Now, the other way that I like to use it, which I feel like is the best way, is to see bullish divergence and bearish divergence. Okay, so I guess I put the BU. All right. So bullish divergence and bearish divergence, these are 2 very, very powerful things that form from the indicator and the candlesticks. All right. So the 3 concepts that you're using when you use the, I don't know why I just erased that. With the divergence, if you're using candlesticks, you're using the trend lines, and you're using the indicator. Notice how everything that I'm telling y'all is going back to the beginning ones, right? So we're learning this in this reason, in this order for a reason. Okay. Notice every time we get to something new, it builds upon the previous one or something that we learned earlier. Okay. So what does the bullish divergence look like? Bullish divergence looks like this. All right. So you have, I'll erase the whole thing so you guys can see it a little bit better. I know it's probably a little blurry. So you have the stock and then you have the RSI. All right. So bullish divergence is when the stock is making lower lows. So the stock would be looking like this, making lower lows, but the RSI would be doing this, making higher lows. Now, notice I said earlier that the indicators only move by how the candlesticks move. So how come if the stocks are going down, the RSI is going up? That doesn't make sense. That's divergence. All right, it ain't supposed to make sense. And what does this tell you? When you see bullish divergence, this tells you that this stock is likely to have a move to the upside. Now, this is best used on the daily and weekly. You can see this on the minute charts, hour charts, 4 hours. They're most powerful on a daily and a weekly chart. 9 times out of 10, they're going to be most powerful on those charts. Okay? That's bullish divergence. Now, let's talk about bearish divergence. Bearish divergence is when the stock is making higher highs, okay? Higher highs, but the RSI is making lower highs. Once again, most powerful on the daily and the weekly. All right. The RSI is making lower highs, stock is making higher highs. And what does this indicate? That the stock is likely to have a down move. And usually when you have divergence, it's going to be a quick move. Like it can happen fast. Like you might see a stock gap up or gap down after it has divergence. You're gonna see that a lot. All right. If you want to see an example of this, like I said, go take a look at DIA from the Instagram page or just look at the chart. You're gonna see it had divergence, but you're also gonna see that it was also at a support and it also had a bullish hammer. Look at those basic concepts that you can use to say, okay, I see this stuff. This is telling me that the probability of this to go up is a lot higher than it is to go down. All right. So think about this. How can you make divergence even more powerful? You make it even more powerful by using it along with levels. If you see bullish divergence on the daily chart at a support from the daily, 9 times out of 10 it's going to pop. 9 times out of 10. All right. You see bearish divergence at a resistance, 9 times out of 10, it's going to drop. Okay. It's going to drop. Now, how far can it drop? You have to understand that by looking at your levels, which I ain't gonna get too deep in that. You're gonna have to go to the YouTube video for that one because that'll get a little bit too complex. All right. So that's really the indicators. And like I said, you got a lot more indicators, but those are the only ones that I use, really. Okay. So y'all, that's it. If you can understand those concepts, you can trade exactly the way I trade. I do nothing that's complex. I just do the basics very, very well. All right. I understand the contracts very well, the levels very well. These 6 or 7 concepts, you can learn those 6 or 7 things. You can be well on your way to being a good trader. I guarantee you. All right. So that's really it. So at this time, what we're gonna do is I'm gonna open it up for questions. So if you guys have a question, I'm about to come back to the laptop. You guys can drop it in the chat or do the raise your hand thing and I can unmute you. So let me know if you guys have any questions. Let me know if you guys have any questions. You can do the raise your hand or drop it in the chat. Let me move my camera back over there. Any questions, y'all can drop them in there or do the raise your hand thing. Anybody got questions? Right. There we go. Any questions from anybody about the pillars of options trading or anything at all? Did this in good times, 8:51. All right. If not, then that's really what we got for today. This is recorded. I don't know if I don't know if I posted or not. Because I kind of want people to be able to tap into it live. Because if everybody doesn't tap into it live, people won't come to the live thing but just watch recording. And it's a little bit better where you can ask questions. So I don't know if I'll post it or not, but if you guys enjoyed it, please let me know if you did in the chat so more people can come and get the information too. Because I feel like this was pretty good. I like doing it on the whiteboard a little bit. I might start doing that more. So if you guys enjoyed this, please let me know in the chat that they missed out. If you guys think of a question later, just shoot me a message. I ain't finna be doing nothing. I'm just finna go to work at like 11, so I'll be up. If you guys think of a question, just shoot me a message. I appreciate y'all hopping on, and we'll be back at it Wednesday at 8. The next class, we're going to be talking about implementing this. All right. So we're going to be talking about more about the probability and putting this stuff together to be able to take your trade with confidence. All right. So that's what we're doing on Wednesday at 8 o'clock. I appreciate y'all hopping on. I'll see y'all soon.